So it's Practical Product Management, the podcast, and today I'm flying solo. Marilyn had a technical difficulty, but I'm not only by myself because I'm here with my friend Greg Cohen, who I've known, I won't even say how many years because that'll make me sound even older than I am. But since I was just a kid, as early in my career, I used to work for a startup, and at the time, the company that Greg was CEO of, they were one of my clients, and so that's how I got to know him. And I've just followed his career, and we've kind of kept in touch over the years. We're kind of both payments geeks, and we have this background, known each other for years. I think we're getting younger. I'm pretty sure, both of us. But yeah, so that's how we know each other. So Greg, why don't you catch us up on, tell us a little bit about yourself, what you're doing now, and just jump in.
Yeah, sure. You're getting younger. I am getting older every day. Appreciate that. For those of you who don't know, my name is Greg Cohen. I am the CEO of a payments business. We work exclusively with software companies called Fortis. We are North American based, and we have scaled about 10x literally over the last 5 years. Wow. I also happen to be an operating partner for a mid-market private equity firm as well, and so get involved in a lot of their business that hits the financial technology area and arena. I think, like I've said, I've been in the payments world specifically about 30 years and watched a amazing kind of evolution. We've gone from the heydays and then, valuations in financial technology going through the roof. And then about 2 years ago, as interest rates started rising, some changes going on. So
yes, for sure. I mean, there was a point at which I was working for the highest funded startup in Europe, right? And then I left, but it wasn't my fault, but I left and then it tanked, right? And so now they're trying to build this thing back up. And so I've been really interested in a lot of what you've been saying. I think you're calling it the Great Restoration and that impact on FinTech and what that looks like. I mean, I'm not really in payments anymore, but like you, that was really, I have a 25-year product management career. I think 17, 18 years of it was in payments and FinTech and kind of that space. So it's part of it. I'll always be a payments geek at heart, and I follow it. So I would love to hear kind of what you see happening, what you think is shifting in kind of this space, and maybe a little bit of how we got here.
Look, I think I have kind of named this the Great Restoration, and there's a reason why, right? And I think everybody knows that coming out of the financial crisis back in 2008, 2009, we had a couple of years of kind of doldrums, and then it was like, money was free, interest rates went to zero, huge investments in the financial technology, but also a lot of the venture, ecosystems, venture capital firms flourished, valuations went through the roof, all of the other things. It also saw the amazing growth of companies today that we put up on pedestals also. Yeah. Look at what all the technology companies today that we look at and their valuations from back then, even the Facebooks and the Amazons, but also when you think about the newer players, the Stripes and the Squares and some of these others that have kind of emerged. But what we've seen happen, with the kind of post-pandemic stimulus, right? Yeah. We saw that continue through there, and then all of a sudden, with every action, there's an equal and opposite reaction. Right. And so interest rates go through the roof, and when interest rates go through the roof, that usually puts huge pressure on investment, especially in what you would call speculative venture and high growth investment. And so literally over the last 2 years, we've seen valuations even of great public companies come down 50, 60, 70%. Yeah. It's happened in the private market. Fundraising for venture and equity hasn't dried up, but it's significantly slowed down. If you took, other than some kind of the pie in the sky stuff, the AI investment in venture, this has been the lowest 2 years of venture investment in the last 15.
Wow.
Right. And so if you took that category out, because that is the shiny new star that people are running to, but that leaves about 50,000 venture cap businesses that are overvalued, that are going to have liquidity challenges in the next year and a half.
Yeah.
And so what that will create, it creates this momentum. And I call it the Great Restoration because it's just like when a hurricane comes through. Through some of these different markets we've talked about. We saw what happened down in Texas last week, but like any hurricane comes through, normally a lot of the smaller kind of older homes, the ones that aren't built on a solid
Right.
foundation, they
Right.
get wiped out. What happens if you've got a house, you kind of build it back up with a solid foundation behind it, or quite
Right.
frankly, new homes come in built on that solid foundation, and you create a much better community years later, because
Yeah.
now you've got all these homes that are built up to where they need to be to withstand the next hurricane and the next ups and downs it flows. And so,
Right.
we're seeing it today. We're seeing, M&A transactions significantly below valuations before. We're
Yeah.
seeing public valuations of companies come down. I think I talked about earlier, come down significantly. And so these struggles that are going to hit businesses, especially what I would say that kind of smaller tier
Yeah.
client, is going to kind of come out, and some of these companies that maybe were light on, compliance and
Yeah.
some of the backbone things, they really didn't have a great path to profitability. They were just going for, I know you like to always talk about, KPIs and things like that. Like
Yeah.
their KPIs were about users. They weren't about like making money,
Yeah.
right?
Yeah.
Like all of those things are going to really come to a head where when they need money, it's going to come into a point where people are going to say, okay, what's your path? Some of these companies are going to get bought.
Yeah.
So there's going to be some bigger companies that are going to want it with some amazing assets out of this.
Right. Right.
There's going to be, some of the companies that the solid ones are going to get funded, and they're going to get funded and continue to scale and be the winners. And then you're going to have a whole crop that just aren't going to make it to another round. And
Right.
I actually think you wind up with a better ecosystem, when
Mm-hmm.
you come out of this, but there's a lot of carnage along the way, but there's also a lot of opportunity along the way as well. If you do it right, if you are a bigger company, you have the opportunity to buy stuff as long as you're buying the
Yeah.
right things and at the right values. And there's an opportunity to create great businesses out of these downtimes. Some of the best businesses were founded, like if you go back in 2009 and 2010,
Yeah.
as they rode the next wave up. So
Yeah.
that
Yeah.
to me is the great restoration, and why I've been preaching about it in my own company and the companies I sit on the boards
Yeah.
of. About it's right now, it is about focus, and it's about scaled long-term profitable growth.
So it's interesting as you're talking, a question came up for me, because obviously during the pandemic, I was working at a Series C startup, right? Like
Yeah.
that we survived, but it was, part of why we survived is the pandemic. If the pandemic hadn't happened, we might not have had the tech that would have gotten us to the next stage,
Yeah.
because I couldn't build it fast enough to keep up with what we were expected to deliver on that fundraising round, right? And as I'm thinking about that, and I'm not picking on them, it's just the nature of where we were in the business cycle.
Yeah.
But so much of what was happening when the money was free and easy and flowing was what you said. Like there were all these startups that didn't have very strong sort of foundations. They didn't have really strong business models tied to their technology plans. And, and then money got expensive and suddenly investors were like, give us something, or you need to make a cut. You need to lay people off. We need to get to profitability, whatever. I also wonder a little, like, I think something you said in there triggered something for me. Like, was the money too cheap? That's one question, right? Was it too cheap, and were we not paying? Were we not investing well? Just when I say we, just as an industry, were we just pumping money at whatever, or were we making bad decisions? Is any part of that? And then the second question is something you said. A lot of these companies were so focused on funnels and conversion and getting your client and keeping them sticky, and they didn't really have anything that was necessarily something anybody was begging for. Right? It was just like, this is a good idea. Let's give it some money and see if it runs. And I'm wondering, like, we changed some of the model of how we even funded companies during that
Right.
season. So am I missing something, or is that
No, I think you're right. Look, a lot of folks, there was so much money, the outsized returns that
Yeah.
investors. When I say investors, I mean the big institutional investors.
Yeah.
Have, these are endowments, and these are massive private offices, and
Yeah.
things like that. When they're putting, generally speaking, they rush to where you get outsized returns. Us
Yeah.
as individuals, we're getting our 5 to 8% as we give it to, our retail broker, but they're looking for,
Right.
mid-teens returns, and they saw these opportunities. So all this money got pushed into the venture
Yeah.
and private equity worlds. And these people had to deploy capital. And so you wound up taking these massive bets across the board,
Yeah.
new funds raised, new funds coming in to go raise this money. And so everybody was getting money. And you were almost in business to get to your next fundraise,
Yeah.
not
Totally.
to necessarily get to a long-term sustainable business model. And and if you said to go get the next $2 million, you just need to have 2,000 users. I don't
Right.
care how you get them, that's what you
Yeah.
got to
Buy
do.
them. Right.
Yeah, go.
That's why Google made all that money.
That's right.
I mean, that's what we were doing. We were buying traffic.
Yeah,
Like we were 100% just, it was all paid traffic, right? And we were just pumping easily a million and a half at it,
right.
right?
So they were
Monthly.
probably just trying to get to that number and not thinking about the cost of acquisition, right?
Yep.
And
100%.
and then the lifetime value of that client that would come in.
Right.
Those are the metrics that you look at for long-term sustainability. But
Yeah.
if your goal and your board, right, we're all kind of driven by what our board tells us to
Of
do.
course. Of
If they
course.
say get 20,000 customers, like hook or crook, and I'm getting 20,000 customers.
Right.
If they're
Right.
telling it's
Totally.
kind of what they're telling you to do
Yeah.
is what drives the business. It also drives the mentality of different folks, right?
Right. Right.
Um, I know.
And I think it's tricky for someone like me, where I mean, I've spent my career working with engineers and building stuff, right? That's what I do. I'm a product manager, right? I take requirements. I want to know what the customer, I'm the voice of the customer. I bring the information in. I get with engineers and designers and we build stuff. And I sort of was in it for let's build the right thing. It's got to have this vision. It's got to go this direction. But there is this moment where you're like, that's all lovely, Leah, but we need to get to the next raise, right? Or we need to get to profitability, or we need to, and I think I think it's a conflict for product managers, right? Because we want to build what customers are asking for, what they want, what we're hearing. And often the board, the investors are saying, yeah, we don't care about that. I mean, they do, but it's not their focus, right?
No, no,
Yeah.
and even if it's out there as the vision of the company to create, ours is create
Right.
remarkable payments experiences, right?
Right.
But like sometimes, I've got a private equity guy who sits on my board and says, "That's terrific, get me this," right? Like,
That's nice. Yeah.
no, totally get
Yeah.
the conflict, and I think like as a project, I'm assuming you probably know this better than I do. Like that is sometimes not even in this cycle challenge. That's this quarter we had a board meeting and said instead of doing that, we'd like to
Oh,
do
yeah.
this.
Yeah.
You get those changes. I just think you saw it a lot more frequently.
Yeah.
And I think the other piece is you saw, especially as money was getting pumped in, or even you got that next raise. The company
Yeah.
went from doing this, oh, we should be doing these other 5 things
Yeah.
too, because I saw this other company make money here.
Yeah.
And
No,
so
totally.
you went from this focused, probably, seed round company that was
Yeah.
really good or creating a stake in the ground on this,
Yeah.
and everyone's saying, well, you should do this and do this,
You do this and this and this and this and this. Right. Yeah. Yeah.
opposed
I
to
mean,
the natural
exactly what you
order
said.
of opposed to the natural order of things, right?
Yeah.
There's a natural order of when to do things, and I even saw that with company, whether you think about the Ubers or the
Hmm.
Squares or the folks like that the world I live in, like all of the stuff that they now have in house, they didn't start that way.
Oh,
Square
no.
was dropping dongles out to consumers back in the early part of the 2012, 2013. That's
Yeah.
all they did
Yeah.
before they got into capital and cash and all the
Totally.
other stuff that they did.
Totally. Yeah. I mean, when I went to Amazon, I literally went to Amazon we were going to compete with Square, right? And I ran the platform for that. We were building the platform to do that. But we had a totally different way of seeing it because we already did a lot of the things that they wanted to do, but they already did things that we didn't do, right? And so it was so from a product and a build and a customer focused perspective, there was to your point, a natural order of what we were trying to do, right?
Right. And you
It
had an
failed. It
existing,
failed, right?
and you have this, it's, one of the things that we've seen come up out of this kind of market is that you've had these high growth startups do this, and then they've had to pull back
Yeah.
right now because
Yeah.
their investors are now saying, what's the path to profitability? So now they're kind of going the opposite way. Let's go focus again. Stop doing this stuff. It's interestingly left a great opportunity for, like, I almost call it the incumbents
Yeah.
to take some of that because they've got the cash to
Yeah.
invest where they see market opportunity, going back
Yeah.
to your remarkable, create great products, blah, blah, blah.
Yeah.
They're the ones doing that now.
Yeah.
While the startups are really just, okay, let me go back and focus in my little hole because I got to get
Yeah.
to profitability.
Right. Right. And it suddenly becomes a real interesting game of, are we going to be able to raise or will somebody gobble us up? And either of those could be a perfectly fine solution, right?
That's
For
right.
the founders, for the team, for whomever. But it's the people I think in the intersection that either don't find a buyer and can't get to profitability now because they are running too lean or not focused enough or their product doesn't have the basics. Like there's an interesting space in there that I think is
Yeah.
there's going to be some like collapse, right? Like,
There has to be, right? There's
yeah,
too many. If you think about some of the problems that have been trying to be solved, whether it's
yeah,
buy now, in my world, buy now, pay later,
yep,
or enabling payment facilitation, or
yeah,
tablet POS, there's too many,
yeah,
right? And so there
yeah,
just needs to be a natural order of things to get
yeah,
that, and that. But it'll also enable some of these companies will get acquired by
sure,
some big bank. They're get acquired by Chase or by B of A
yeah,
because they were doing something B of A wanted to do and could never have built it in house.
sure, sure. No,
And
for
so
sure.
I think it's great, but there's going to be a lot of things that just don't make it to the other side. And that's why the fundamentals matter. If you've got that, whether it's continuing on your own or continuing as part of someone else,
Yeah,
you've got a path to get there. And that's where your project management stuff, the hard part about project management, sometimes you are being told what you need to product manage opposed
yeah,
to helping make that decision of what
yeah,
that
yeah.
should
It
be.
depends on the level, right? I think it depends on where you're sitting. And I think for Marilyn and I who do this podcast, I mean, she's sitting pretty significant in her spot. I was running, teams and I was running, I mean, I was the chief product officer at the last company and,
Yeah.
and so you're making these decisions, but sometimes you're like, you're asking me to do something that goes against what I do, right? And so you have to sort of decide like, well, how can I do this for a while or do I want to do something else, right? And I think that's every product manager, every engineer has to face like, what do I want to do, right? What's interesting to me?
Yeah, and I'll take it up. One of the things that you said is that it may or may not work out for the founders and the this and that. The other is that right now, one of the challenges is if you've raised money at a billion-dollar valuation,
Right.
but in reality, your public competitors are trading at a value that is 60%, 70% lower
Yeah.
than it was 3 years ago.
Yeah.
That billion-dollar valuation really should probably be 400 million to 500 million.
Totally. Yeah.
But now you've got investors that put money in at that value. You wind up with a very complicated discussion
Right.
when you think about your next steps as a CEO or as a board and how prefs go. I have seen founders basically move into having jobs opposed to having any realistic upside values
Yeah.
because of the way that they had built their capital stack.
Yeah.
So
Yeah.
it's just going to be a very interesting. That's why I call it the Great Restoration. There's
Yeah.
just going to be a lot of things happening.
Yeah. Yeah. No, totally. It makes total sense. Do you think it will change? I mean, maybe it has to, but how do you think it will change how we put together leadership teams and think about leading companies?
Oh, I mean, we're seeing it already, right?
Yeah.
I talk to, I get pinged by recruiters all the time to ask me who I know who can do this or do that or
Yeah.
do this.
Yeah.
I think it's a fundamentally different way to manage a company.
Hmm.
It's a different way to manage sales, a different way to manage all go to market product,
Yeah.
project management when you are thinking about a business built for scale last, long-term facility. It's
Right.
almost like you hate to say that it's almost like how do I go find some old school folks to go help out the new school
Yeah.
guys and sometimes
Yeah.
or girls. And the hard part is some of the new school girls and guys like may never actually be able to survive in
Right.
a kind of this scalable growth model because
Yep.
the term I used to use is product monsters. Product monsters die. Like this is so foreign to what they do
Oh yeah.
in a world that like we're going to do this and do that. Like no, I want to build this and this feature. That I'm like,
Yes.
oh, we only have so much capital.
Right.
It's got to
Slow
go from
down. Right. Right. No, I think that's a really good point. And I think, what one of the things that I saw a lot, living in Berlin and I used to go to this, I was the CTO as well for this company and I used to go to this CTO club and, I was the only woman in that group. It was 36 men and me, which was, but one of the things I saw a lot of in that environment was there were entire startups that were well funded and they had product people, but they had no product leader who had ever done it for more than maybe 3 years or 4 years. And here I am, I'm like, how long have you been doing this, Leah? 22 years, right? Like I started it, I started way back when I was working at Electronic Clearinghouse before I worked for Safwan and those guys, right? Like I've been a product manager for a long time. And one of the things that I've seen is that particular set of young product managers, they're eager, they're well taught around the theory. This is part of the reason Marilyn and I started this podcast, right? They get the theory, they've read the books, they've been in this cycle of like growth product management. How do I chase conversion? How do I get the number of users? But they don't know what it looks like to build the black box and get real focused and real still and hone in on that and turn profitability on. Right? They just haven't done it.
By the way, you've got that. That's not just a product. Like that is in every functional area in many of these companies. And I would tell you that some of the companies like reject the old, right? In some ways, that was kind of their DNA. Look, we're not hiring Leah because she only knows this. Like we're just hold on. Here's the word. We're disrupting everything.
Right.
Okay, well, great. And as you continue to get capital, they would make, and part of it's actually making the market more rational.
Yeah.
Like, some of these companies, and you may have worked for some, were doing things that were just irrational in the market and forcing, in some cases, people to go chase, like giving away product or doing things like this. And like a lot of that irrational, go-to-market and sales stuff has dried up a little bit too, which is good. It makes for a better long-term business model, because what you don't want is, especially in the world I live in, when you're moving money around, if one of these companies doesn't make it, like there's dollars sitting there, and we've seen, we're dealing right now with a business that a banking as a service business that failed, and I won't name names here, but like sitting on tens of millions of dollars of consumer deposits that have gone poof, right? So.
Right. No, and I think it's a good point, and I do think that there is often in this space, I would say the couple of startups and scale up that I worked for in Europe since I've been here, I would say a lot of times I was saying, they would be saying, go faster, go faster, go faster. And I'd be like, listen, I got to do this and then it's going to speed up. Like I know how to build, there's a pace, right? And I've got to get the team honed in on what we're doing. And then I can turn the heat up, right? And they can run faster. That's not a thing that a lot of these startups understand. Because all they know to do is go breakneck at it, because they've got, people breathing down their necks. And I get it, but it's just such a different world, right? So.
Yeah. But look, I think when you get through it, look, some of these companies, you've already seen layoffs, you've heard announcements of layoffs here and there.
Tons,
it's interesting. By the way, you notice public companies, as soon as they do a layoff, do you know what happens to their stock? It goes up. It's like you think, wait, I just let all these people go. That means that's bad stuff. The investors are saying, wait, you're getting back to discipline.
Yeah.
Right.
100%.
And that's kind of what the investment community is saying in those scenarios. We need to take that lesson a little bit. It's not about laying people off. It's about focusing on what your core competency is.
Yeah.
Finding partnerships to do some of those, doesn't mean you can't do X or Y.
Right.
Find a best of breed there, plug it into your system, and then opposed to trying to just build everything and do everything yourself, and maybe getting that, be disciplined on the roadmap and managing those things, right? And making sure compliance is nailed down on the back end as well.
Well, and I think it's similar to the big companies having that stock moment. I saw a lot of things where companies would get a fundraise and then immediately turn around and do a layoff. And people were like, we just had a party to celebrate our fundraise and now you're laying us off. And I was like, yeah, they had a fundraise because they promised they would lay you off. That's what happened. So sorry, you got laid off because of a promise. And I tried to sort of educate on that. And what was important for me was learning how, when we got money, you didn't just go hire double the size of the team.
Right.
You base it on milestones. You hire what you need to start delivering. And if I meet this milestone, then we hire 20 more people. And if I meet this milestone, we hire 100 more people. Like, there are things you do. Yeah. Right. But that's so old school.
Yeah.
Right.
Well, look, you right now in this environment, look, whether it's venture debt, whether it's traditional debt, whether it's just equity investment, it's like, how do you string that on as long as you possibly can? Because you've got to get it to where you may not be another round at the other end of that.
Right.
So at the end, as these things come together and your expense burn is here and your
Yeah.
profits are here, like when do they cross? And so you
Yes.
need that next investment to get you to here.
Exactly.
And
Exactly.
that is the goal of every round right now. And that's
Right.
why, to your point, you said it exactly. They gave you money, but said, you got to, here's your money to get to profitability. Do this and this to help do that.
Yeah,
Right.
we'll only do this if you make this deal. And you're like, all right, we need the money to get 18 more months.
That's right.
So we got to get rid of, a quarter of the population, right? Okay. I mean, it's terrible. It's terrible to have to do it, but that's the deals that are being struck. You
Right.
know,
And then I think in a lot of the companies, as long as if they're decent, I mean, if they're really small, it's hard. If it's
right.
50
Oh,
people, it's
yeah,
still a hard thing to do.
exactly.
In the
Exactly.
bigger ones, you're saying, okay, this division, like maybe it makes sense for us, but
Yeah,
not right now. And they'll take the
exactly.
entire division and say, we're not going to do this. Right.
Right, right, right. So I mean, it feels a little like what we're saying is there's some interesting things that we've learned through sort of this season, and some things that we're seeing that some of the startups and some of the kind of older companies are the big companies are doing, that we're like, yeah, keep doing that, but let's start to infuse it with some of the things we already know about running a good business model,
Yeah.
right? And find a bit of a balance there.
Yeah. On the back of what I would say is interesting, you got a regulatory environment right now
Yeah,
across the globe. Like this isn't
yeah,
just that is pretty. I won't say it's anti-business, but like M&A, some of the big M&A has been taken off the table,
yeah,
especially here in the U.S. Right, with
yeah,
the new kind of some of the things that can't be done.
yeah.
You've got banking regulation and auditors in my world that have become a
Hmm.
much bigger piece of that. So like, but what does that mean? It doesn't mean you don't do what you're doing. It means, oh
Right.
my goodness, I have to invest more of those dollars into like compliance.
Yeah,
Well, that
100%.
doesn't help me get new customers.
Right. But I want to stay in business, right? Totally. I mean, when I was working at Amazon and in the platform team, we had a whole team that was keeping us from being a bank, right? And so
Yeah,
we were always doing this like, dance where we would build something and then be like, okay, how close to the banking line does that get us? We don't want to be a bank, right? And so,
yeah,
but you spend the dollars on that overhead to get to the next thing, to the next customer, to the next,
that's that's right.
whatever.
And it also creates a moat where other people aren't going to make that investment, what have
Yeah.
you, and they get in a bad spot. The good news is you were at Amazon and you had unlimited capital cash
Right?
coming in to fund that, right? Where others
It's raining
others
money.
aren't in the same are others aren't in
Totally.
the same boat. So
Totally.
it's
Totally.
been fun to watch. The other area that I talk about is as you scale up, the investment that people don't think about is that we just call it RTB, run the business.
Yes.
Like you got to be operationally efficient, right? Our job is we want our OpEx to grow at
Yes.
a lower rate than our revenue is growing,
Hmm.
right?
Hmm.
Unless you're making some big investment, you
Right.
capitalize it with that. But like
Right.
that's how you think about operating leverage. And
Yeah.
any business needs to think about like as you scale, you
Yeah.
can't outspend your revenue. Like that
Right.
your revenue should always be growing faster than your OpEx. And
Absolutely.
so the one way to do it is around people. The other way to do it is around technology and innovation and things like
Yeah.
that. And like that's an investment. And so when you think about your dollar allocation into technology
Right.
and systems, like it's got to go into you got to scale your business. When you go from 100 customers to 1,000 to 10,000,
Right.
like there's a big investment needed there to scale
Yes.
that, right? And so
Totally.
that's the other piece that I think a lot of these folks forget. They got to here and they're like, okay, now we're going to get to this next level. I got the dollars. I want to go create these next features. Oh, geez, but our service department needs this. Our
Right.
risk department needs that. Like we've got to double our capacity over cyber,
Right.
security, like
Right.
all of those things. Right?
And you find, I mean, I see a lot of companies in that situation then saying, okay, well, now I'll partner with somebody. Now I'll hire somebody to do these pieces. Well, those are expensive contracts,
Yeah.
right? Like but you can't build it fast enough if your team's not big enough and you don't have that expertise. So you go have these partnerships that now lock you into contracts
Right.
that you're like, can I
Or
afford
I
this?
mean, you
Right.
ever implement Zendesk or implement NetSuite? Like these are not like
Salesforce.
yeah,
Exactly.
Salesforce. These are not like A, they're not inexpensive, and B, the
Nope.
implementation of these things is a project in and of themselves
Yes.
throughout your entire and a massively disruptive project, right?
Totally. And they lock you in to, once you head down that road, it's real hard to unwind,
Yeah.
right? I can't unring the bell, as they say, right? It's a tough one. So
Right.
yeah, 100%. All right. I have one sort of totally separate question for you that I just want your opinion on. What do you think is what do you think is going to happen with buy now pay later? What do you
Oh,
think it's like?
I think I think look, it is a tender type that the
Yeah.
market there is demand for it.
Yeah.
So that's good, right? And so we know that it's here to last.
Yeah.
I think what will happen is, I think, which is a good thing, is it will get regulated, and
Yes.
that will get out. And actually, for the mainstay players, the
Yeah.
Affirms of the world and folks
Yeah.
like that would be great. Now we've got the rule book, and
Yes.
everybody else has to play in this rule book. And so things like their competitors that were doing what I was saying that were those irrational market things, those go
Yeah.
away.
Yeah.
And only the compliant companies, the ones that play by the rules, the ones
Yeah.
that can scale, will survive. And so that's where I think buy now, pay later fits. It is a payment.
Yeah.
It will not, like Visa and MasterCard aren't going away.
Right. Shocking.
um, this is a payment method
Yeah.
for certain consumers that they want to use. And I think it actually evolves from just like I call it point of sale financing
Yeah. Of
more
course.
than just, I think there's huge applications in the B2B environment, which we haven't
Yes.
seen. It's mostly been consumer
Yeah.
focused,
Yeah.
and other verticals. I mean, we see a little bit in healthcare, but it's okay what's done in that
Right.
space. Like there's
Right.
other pockets where point of sale financing can significantly scale up. And I think with the rules of the road and
Yeah.
vertically focused folks going after that, which have the compliance things and aren't, quite frankly, aren't taking advantage of consumers.
Right.
Once the rules are written, it makes it a lot better business, but it also means there's a lot of companies that aren't going to make it through.
Yeah, it's interesting because when I was in that space, I would say, like, well, if you want to break into the U.S. market, you have to decide, you have to get over the fact that you're not going to replace Visa and Mastercard, and you have to figure out how you're going to build a consumer base that is you can handle them still having a credit card, because in the US at least, you got to have one or you can't rent a car, you can't get a hotel room, you can't do any of these things until you regulate and get this payment method kind of being
What,
credit scored or what, in those ways. And for me that was always the, like, you can't do one thing and say you want to be something else in this particular payment method.
but since you brought it up, I'll throw it out there. Like it's a
Okay.
lending, by the way, it's a lending business. It
It
is.
is.
It's
Totally.
not like there's a technology component of the way it goes to market, but at the
Yeah.
fundamental of this is an asset-based business. And when
Yes.
your cost of you think about the market, if your cost of funds goes up, which happens when interest rates go up,
Yep.
and if your loss rates actually start to go up, those are like working against each other if you start to think about an economic downturn. And so
Yep.
that's why you have to price this product appropriately, where you
Right.
wind up it's not just about how much capital you can put out on the streets. And I think that's
Exactly.
where people right now, especially some of the smaller companies, really got burnt as their
Right.
cost of capital went through the roof, and
Yeah.
then their delinquencies or their charge-offs went up. It's not a lot different than managing a credit card portfolio.
Right. And especially in the spaces where some of these players were backing the transaction with a card,
Oh yeah.
right? So that's how you're deciding if you're even going to give the transaction is checking a card. And I'm like, okay, that's, like this, there's a game being played there that is a tricky game to play,
Oh
right?
yeah.
So,
People were paying merchants to accept
yes.
their buy now pay later tender and then giving it away for almost free to the consumer. I'm like, this model, and going back to the irrational business models, most of those have
Right.
gotten cleaned up now, right? You've seen it
Right.
happen. So,
Yep. Yeah, for sure. And I think one of the things you said that sticks with me, I think I say the same thing about coaching. Like, I'm a coach, right? And there's a lot of coaches that are really anti-regulation of coaching. And I'm like, no, if you regulate coaching, then it legitimizes what we do. And people don't say things like, everybody's a coach these days, right? Like, anybody can say they're a coach. And I'm like, no, I'm for it, right? But I think that's also a part of my life, right? I've worked in payments and health tech and all these things that require regulation to legitimize what you're trying to do so that people feel safe. And I think buy now pay later is the same. And so I'm glad to hear you say that that's where you think it's
I
going.
like I like I like uniformity. I like compliance. When it gets to go to market competitive natures, that's where I
Yeah.
absolutely that to me is where the regulatory stuff
Yeah.
needs to take a like just relax a little
Go
bit. Like let
away.
market dynamics play
Yes.
themselves out,
Yeah.
supply and demand, and the best, like that's agree, agreed.
Yeah.
But like creating a level playing field,
Yeah.
is really what the regulator should be doing.
Awesome. And then the last thing I'll ask you, and then I'll let you go. What are
Yeah.
you most hopeful about?
What am I hoping?
In
Look, for
yeah,
every one of these changes creates amazing opportunity on
yeah,
our company. We just did our largest acquisition in January of this year
yeah,
because it was an asset we never could have gotten had the parent company not bought something they never should have bought, right?
right.
And so we were able to do a corporate carve out and buy that so to me, coming out of the great restoration, you wind up with this great upside momentum. The valuation, interest rates now, at least we know with kind of where they've capped out at.
Right.
Maybe they shrink here and there, but like
Right.
we're not going back to 2020,
Right.
but like for everything else, we did a 180-degree about face. Like we
Yeah.
went too far this way on where valuations are now. So there's
Right.
a rebound that comes out of this. So the ability to get better assets, invest in the growth businesses going forward as an investor, to watch that new coming go. Like,
Yeah.
and I'd say we just let's learn. Here's what the definition of insanity, right? Like, let's not go there. Let's learn from what we did before
Yeah.
as you choose where to put your money, as you build your business going forward and what you buy. And if you can stick to those principles,
Right.
like I actually think, I think we're going to have, 20, I would say 24 and even a little bit of 25, you're going to see this rockiness and this, but this is the great time to like maybe find some cool assets, or
Yeah.
whether that's invest or buy or what have you, into these really cool things, and then watch the market come back, come back into the
Yeah.
market, 2, 3, 4 years from now. And that's, the investment horizon, right? You think about, these sprints of, 5 years, like things change a lot in 5 years,
Yeah.
right?
Totally. I mean, I'll even talk about politics. That's a whole nother game that's going to change things in the next few years. So,
Oh yeah,
yeah.
that's right. That's a whole nother podcast.
That's a different podcast. I don't even want to have that conversation. Greg, thank you so much for coming by and talking to me today and spending some time with us. It was super helpful.
Awesome. Well, great to reconnect, and
Yeah.
good luck with everything. And
Thank
we'll
you.
chat soon. Thank you.
Awesome. Thanks.